Afternoon, everyone. As required by the Federal Credit Union Act, we're meeting today to hold a public meeting on the proposed NCUA budget for 2026 and 2027. I call this hearing to order. In addition to those joining us in the boardroom today, I want to note for the record that today's meeting is open to the public through a live webcast as well. For anyone watching online, if you want to view the closed captioning of the meeting, please click on the CC icon in the lower left of the WebEx window. You can also change the layout to one of your choosing by clicking the layout option on the top right of your screen. Our recommended viewing is the stack option. I want to start this budget hearing by thanking each of the individuals who are here to provide remarks. I'd also like to thank people who submitted feedback through regulations.gov. The budget for 2026 looks very different than the budgets we've seen in the past. You may also notice that this year's budget hearing, for what it's worth, is a different location. By hosting the budget hearing in this boardroom, we're saving agency funds and allowing us to use this big screen. Prior years were in our event space downstairs, which had its advantages, but it costs like $5,000 extra, so we're saving that. Since my first year at NCUA, I've been committed to identifying opportunities to reduce costs and operate more efficiently. I consider it a requirement of anybody on the NCUA board to try to reduce costs where possible. Since becoming chair, I've made the decision to reduce my own staff by 20% and lowered our operating expenses from year to year. My colleagues at NCUA have done a great job finding ways to reduce costs and refocus on NCUA's core responsibilities. 2025 alone, we reduced contract spending by $16 million, decreased personnel by 23% through voluntary separations. And yeah, we have a smaller workforce, but this team represents what efficient government looks like, efficient government. Our support of credit unions has not stopped or stalled. We're driving efficiencies through improved technology, streamlining process, and reducing unnecessary burden for both credit unions and ourselves. We're in a rare position to refocus priorities and provide new opportunities for our staff to advance their careers. I want to acknowledge that what we're doing at NCUA isn't unusual at all in the private sector, which is where most Americans work. The private sector is the only source of wealth and the only reason any of us can eat dinner tonight. Credit unions have to prioritize and make tough decisions, conduct layoffs, close down entirely, all those painful things that are necessary in normal life, but considered unusual in government. Before we get our remarks from guests, it's important to note that the NCUA staff draft is just that, staff. It's not a final product. It's a baseline and a starting point for us to build with the feedback we'll receive today, but it's just a part of our budget planning process. It's our goal that today's hearing increases the public's understanding of our priorities and clears the way for an informative dialogue to pass a budget later this year. We're going to start the hearing with Melissa Loudon, acting CFO, and Jim Holmes, supervisory budget analyst, presenting the staff budget for 2026 and 2027. Following my questions to Ms. Loudon and Mr. Holmes, we'll then have a four-person panel of stakeholders offering their perspectives on a proposed budget. That panel is Kurt Long from ACU, Jason Stebrak from Defense Credit Union Council, Jennifer Wagner, Go West Credit Union Association, and Michael Edwards, Cooperative Credit Union Association. Each member of that panel will have up to 5 minutes to speak, and I ask you please respect that time limit. Also, we received the written comments submitted by the panel, which will be included as part of this hearing record. After each stakeholder presentation, I may ask questions of each presenter. And for the final portion of our hearing today, the participating stakeholders will be able to ask their questions of NCUA staff. Each of you have 5 minutes to do that, all right? Melissa and Jim, begin when you're ready.
Thank you. If we can get the slides up, great. Yeah. Hello, I'm pleased to provide an overview of the staff draft budget today. The staff draft budget document was posted on NCUA's website on September 25th and published in the Federal Register on September 29th. The period for public comment is open for 2 more days until Friday, November 7th. Next slide. This slide provides an overview of the proposed budgets for agency operations. The $313.8 million in new budget resources would be a decrease of $81.6 million, or 20.6% relative to the board-approved budget for 2025. Compared to the level previously approved for 2026, the proposed budget is 25.2% lower, a decrease of $105.7 million. As part of this proposal, from 2025 to 2026, the NCUA's level of authorized staff falls by 288 positions. These reductions are all consistent with efforts implemented by the administration since January 20th to reduce the size and scope of federal operations. Slide 3. Several changes to the NCUA's operations drive next year's proposed budget. The first being reductions to the workforce. As I previously mentioned, the budget decreases NCUA staffing by 23% as compared to the 2025 authorized level. This lowers employee compensation because there will be fewer employees. Second is extended timeframes for credit union examinations, which were announced last April. This allows NCUA to reduce exam frequency for well-run credit unions by better matching examiner resources with identified risks. When combined with off-site analytics, this lowers the budget for the examination program. And the third is lowered projections for travel spending. These result from a smaller workforce that continues to find new methods for off-site examination analysis. When combined with reduced spending for contract support from vendors, the non-payroll share of the budget decreases 25%. The 2026 proposal also allocates $10 million in the capital budget for costs associated with the NCUA's forthcoming reorganization and for technology investments that we expect will enhance employee productivity and effectiveness while improving customer experience. Slide 4. This slide provides more detail on the 2026 operating budget, which is proposed at $292.4 million. This is a reduction of $90 million, or 23.5%, compared to the level approved by the board for 2025. The operating budget supports a staffing level of 967 positions, which includes all NCUA staff except for 3 positions funded by the Independent Central Liquidity Facility. Budget tables in the staff draft reflect headcounts by office after the voluntary separation program departures, plus 23 unspecified positions. But these FTE counts do not reflect future state organizational decisions. The table on this slide shows our standard budget categories to highlight how we propose allocating our resources. As you can see, the budgets in all categories decrease in 2026. Because of the reductions to the non-payroll budgets, employee pay and benefit expenses now make up close to 82% of the operating budget. In 2025, employee pay and benefits were approximately 3/4 of the operating budget. Slide 5. This slide summarizes the NCUA's capital budget, which funds long-term investments. The 2026 capital budget provides $18.1 million for information technology investments, central office building maintenance projects, and reorganization-related investments that align with government efficiency goals and administration priorities. Information technology investments and hardware require significant capital expenditures for modern organizations. The capital budget's 2 largest projects are for replacement of the NCUA's laptops, the current fleet of which has exceeded its functional life, and for cyclical merit system software upgrades. The budget also funds the transition to a next-generation customer relationship management system because the current system will no longer be supported by the vendor. As noted earlier, the capital budget also includes $10 million for projects and investments that will support the NCUA's reorganization in 2026. Slide 6. This slide outlines the Share Insurance Fund administrative expenses budget. The budget pays for all costs directly related to share insurance, including support for the Corporate Resolution Program. For 2026, this budget decreases by approximately $2.4 million, or about 41.6%. The main driver for this decrease results from offsetting the budget by using proceeds from the sale of the Austin office building, which was completed last quarter. Slide 7. The NCUA prepares a 2-year budget, although it is our practice to present updated budgets for board approval on an annual basis. Slide 7 shows projected estimates for the 2027 budgets, which total approximately $344.7 million, an increase of $30.9 million, or 9.8%. It's important to note that the 2027 estimate is $50.7 million, or 12.8% lower than the budget for 2025. The slide also highlights that the proposed 2026 budget is $105.7 million lower than the 2026 level previously approved by the board. For 2027, the estimate is $116 million lower than the estimated 2027 level if the previously approved 2026 budget grew by the same 9.8%. The NCUA reexamines each year's budget, and part of our analysis next year will be to assess whether unspent prior year funds could lower the 2027 projection. Slide 8. This next slide depicts how the NCUA finances its operating budget consistent with the Federal Credit Union Act. Most of the operating budget is derived from two sources: the operating fee paid by federal credit unions and the overhead transfer that draws from the Shared Insurance Fund. The chart on this slide illustrates the portions of the budget paid by federal credit unions and federally insured state-chartered credit unions. We estimate that the federal credit unions cover 69.8% of the 2026 budget, which is modestly higher than the 69.3% covered in 2025. The federally insured state-chartered credit unions would pay the remaining 30.2%, down about 1/2 of the percentage point from 2025. Slide 9. This final slide shows an example of how the NCUA's budgets, including the Central Liquidity Facility and the Community Development Revolving Loan Fund, are incorporated into the President's budget submission to Congress. Because the rest of the federal government operates on an October through September fiscal year, the estimates shown in the President's budget vary from the NCUA budget discussed today. Thank you to those who have already taken time to review our budget and send comments, as well as to the presenters who will provide their views today. As a reminder, the deadline for written comments is this coming Friday, November 7th. This concludes my remarks. We are happy to answer any questions.
All right, thank you, Melissa. About that graph, credit unions obviously probably appreciate significant reduction for next year. That 2027's got a little spike to it, right? Almost 10%, that projection. That bottom right there, that blue, that's what we're talking about. That gives back a solid chunk of the savings. Can you talk about why that spike is there, and can we contain that cost, and what our track record is when you do similar projections?
Yes, thank you for the question. So while 9.8% growth is significant, the estimated, and I said this earlier also, but the estimated 2027 budget is still $50.7 million, or 12.8% lower than the board approved for 2025. And there are several reasons for the projected 2027 increase. We estimate that the compensation and non-payroll costs account for 3 percentage points of the growth. That means programs funded by the budget will grow at or near the inflation rate. The remaining 6.8 percentage points of growth result from us projecting a smaller surplus from prior years to lower the overall 2027 budget spending. So, for example, this year, we reduced the 2026 budget by $3.4 million that we collected by selling the NCUA's former office building in Austin, Texas, which was really a one-time transaction. So additionally, we expect that because the 2026 budget is substantially reduced, we will end next year with a comparatively smaller year-end surplus going into 2027. I'd also point out that even though we present a 2-year budget, in each year following, we always re-estimate what had been projected in the previous year. And over the past several budget cycles, we have consistently been able to lower the budget growth in that subsequent year's budget re-estimate. I also expect this year we'll be able to recover additional past year funds, which can offset the 27 budget growth. So looking forward, I'll work with my staff to sharpen our pencils, and we'll update the draft budget's projections for 27 to present a more informed estimate of our budgetary needs for 27, which the board can consider as part of its review of the final budget in December.
Yeah, so even if we agreed with the staff budget exactly as it is, said, yep, you're all set, go ahead. That $344.7 million history you're showing, usually comes in a little lower than that, right?
That's correct.
All right, and even if it did come in at that, let's call it 345 million. I don't think it will, but that's about the same as if you go back to 2020. That would mean, and I bet in 2020, if somebody had said, one of your expenses, your regulator, is going to go 7 years from now is going to have the same budget in dollar terms, exactly the same nominal terms, you would have said, deal, I'll take it. Throw in inflation, and it's actually 20% smaller over those years. Okay.
Chairman, can I just
Yeah,
add
please
to
do.
that? So,
Yeah.
there's a pretty long runway in developing the staff draft. So this starts, what, May typically, June?
May.
Yeah,
Yeah.
May.
May.
And so, at that point in the year, we have the best information we have at that point. And so, if you look on page 11 of the staff draft, for example, you can see some history on what we've used as offsets and what we assumed as offsets for 2026 and 2027 here in the staff draft. I think the point that I just want to emphasize is that now that we know what we know here in November and going into the end of the year, what the CFO is likely to present to the board for final budget, that 2027 number won't reflect a 9.8% increase. It will be lower than that.
Yeah.
We have new information that will have additional offsets. That number will come down. It'll still be
Yeah.
positive, but it'll be lower.
I know. It wasn't just the administration suggesting buyouts, and that sort of thing. I know we're a monopoly government provider, that we're a government agency. There's always changes. It's just the nature of the beast. Although I doubt any of these four organizations are spending the same as they did 7 years earlier, from 2027 to 2020, right? Without accounting for inflation, literal dollar terms. So I think that's pretty positive. Obviously, if you are a federal credit union and we actually bill you, I think even somebody who didn't pay any attention to what's happening in DC, and bless them if they don't, if they saw that bill, whatever they get, they will notice that is noticeably lower, right? Even because your credit union has gone up and down in size, so it's always hard to tell. It's going to be like, whoa, right? It's like, we all probably get utility bills, and you're like, wow, high or low. It's enough of a difference from what you expected that you notice it. Whoa. So this can be noticeably lower if you are a state charter. What this means is not necessarily that you can budget for some extra money next year. It just means your insurer is in better shape, meaning you are closer to us returning money. You are your insurer is further from the level at which we would have to assess premiums. So that's sort of the mechanism by which you would get that money. It won't be straight cash next year, but that's how the state charter system works. We have Melissa. I'll tell you what, let's turn it over to Kurt. You're up.
All right. Good afternoon, Chairman Hobbin. On behalf of America's Credit Unions, thank you for the opportunity to deliver remarks before you today regarding the 2026 and 27 staff draft budget justification. My name is Kurt Long, Chief Economist and Vice President of Data and Research. Thank you for the board's leadership and ongoing commitment to ensuring a safe and sound credit union system and improving the lives of over 144 million credit union members across the country. We appreciate that the proposed budget reflects a meaningful overall reduction in spending compared to the prior two-year plan, signaling the agency's commitment to careful resource management and responsiveness to stakeholder concerns. A more modern, risk-based, and innovation-focused supervisory framework depends on carefully directing spending towards the areas of greatest impact. The budget should not only fund ongoing operations, but also drive internal efficiency, improve accountability, and ensure every dollar contributes to mission success. A well-structured budget should support the agency's core goals of safety and soundness, access, and operational excellence, while promoting modernization and long-term savings. The NCUA's voluntary separation program and the federal hiring freeze creates an opportunity to rethink operations and build a leaner, mission-aligned workforce. To accomplish this, the agency should consider redirecting hiring funds to modernization that reduces recurring personnel and travel costs. prioritizing collaboration and technology over duplicative roles through shared service models for HR, procurement, and IT, and adopting hybrid or virtual field offices. The agency's supervisory strategy should also evolve by focusing examinations and travel on the highest risk credit unions, supervising low-risk institutions remotely using data and analytics, and tying staffing and travel budgets to risk tiers and performance history. The NCUA should right-size its specialized offices, ensuring resources reflect real risk and avoid duplicating the CFPB. Spending must be tied to measurable results with a focus on efficiency and modernization. Savings from reduced travel and staffing should fund technology that automates supervision and strengthens data analytics. And the agency should invest in innovation, helping credit unions safely adopt new tools and technologies for the future. We thank the NCUA for its careful stewardship and its proposed 2026 budget, which is 20.6% lower than the board-approved budget for 2025. We commend the proposed operating budget of $292.4 million, $90 million lower than last year, including a 20% reduction in the supervision budget and a 36% reduction in the administration budget. These reductions help to address prior concerns about unsustainable costs and reflect renewed focus on the agency's core mission of protecting credit unions. We also appreciate efforts to reduce headcount. A total staffing level of 967 positions and a pay and benefits budget of $239.6 million appear far more cost-effective as the number of credit unions declines. The NCUA should avoid understaffing and ensure consistency in examiner experience and staff points of contact. We support the NCUA's IT spending reductions, but urge caution to avoid weakening cybersecurity or system reliability. Prudent technology and cybersecurity investments are essential, but they must show measurable impact and efficiency gains. The agency should provide greater detail on its capital projects, including any AI use and how those tools will improve productivity. Finally, if reorganization affects regional structures or examiner staffing, credit unions deserve transparency to ensure supervision remains responsive and regionally informed. We support modernizing examinations through merit. Regarding merit enhancements, the budget states that funds will, quote, re-platform loan and share data analytics applications to the NCUA's common analytics platform, unquote. The NCUA should brief credit unions on merit's progress and the status of this project, differentiate this re-platforming effort from prior cloud migrations, and improve transparency by posting future RFPs and notices of awards so that credit unions can track contracting budget changes from year to year. America's Credit Unions urges the agency to carefully consider and adopt the suggestions outlined in these remarks in its final 2026-27 budget. We thank the NCUA board and recognize the NCUA staff's hard work in preparing this budget justification and other budget materials. Thank you again for the opportunity to deliver remarks before you today.
Thank you, Kurt. You mentioned a bit about tying spending to results and efficiency gains. How do you propose we do that, establish and report on those metrics? It's a good idea, but how do you see it happening?
Right, always challenging, and I think we would not want to be overly prescriptive, but just to concretize it a little bit, did note that in the 2021 and 22 budget, there was in the capital budget section a reference in the to something called the Return on Security and Infrastructure Investment, or ROSI, I think is how you might pronounce it. And so we noted this with interest, and I think in the as this measure was laid out in the budget justification, in the numerator, they contemplated measuring the expected economic gains from these technology investments. And so, granting that this is always a challenge and there are, assumptions involved, we do think this is a healthy process that improves transparency, even where stakeholders may disagree on some of the assumptions involved. But we also note that there was no further notice of ROSI in future budget presentations. And then on the examination side, one idea might be to measure the time it takes to produce various exam reports, both pre and post introduction of technology, AI. That could be a way to sort of measure how much those introductions have enhanced productivity.
Gotcha. And the other one about concern that a reorganization could affect our regional structures. Officially, we have 3 regions. I guess way before my time, they had 5, and then there was another one of these cost savings, and they went from 5 to 3. I'm of the opinion that regions are good. They could provide comparisons. Obviously, you can go down from 3, but not, Could you get any examples from ACU world where regional knowledge being closer to the credit union geographically and their members contributed to a better supervisory experience?
Sure. So I think a classic case would be in rural communities that are maybe more tied to the agricultural cycle. So an examiner with local knowledge might be better positioned to assess a credit union who is subject to some of those sort of seasonal cash flow fluctuations, and then apply that knowledge to getting a better assessment of the risk in that institution. And I think we mentioned in our letter potentially a hybrid model. So I think the goal there would be to move more of the supervision function to a remote posture, but also to have adequate regional specialists who could provide their expertise as well.
I gotcha. One positive of COVID, one of the only ones, was everyone had to figure out how to use Teams or Zoom, and you had to be able to do it by yourself. And for the same reason, all of us do virtual meetings all the time now. But I hear you. Being close to it matters. You have to understand that they're focused on the soybean crop, or the one in New York City does the Broadway industry. When they were closed for COVID, right, they were very conscious of that. Right, it matters a lot. The same way that can be geography and that can be field of membership. Shout out to the credit unions that this week are paying federal employees because their field of membership is federal employees. The people at Citigroup and B of A are not evil, but the federal employees that bank there, those folks understand there's a federal shutdown. They don't argue. They know that you always get paid back at the end historically, but they're still not paying it because that's not their forte. Because geographic or field or narrower membership knowledge matters, right? Lots of federal employees are getting paid on time and lots of them are not. And the difference is how focused their financial institution is. I'll stop there for Kurt. Jason, up to you.
Thank you, Mr. Chairman. Thank you for this opportunity. The Defense Credit Union Council appreciates the opportunity to give testimony on the National Credit Union Administration's proposed budget. We'd like to thank the NCUA for providing this forum for stakeholders. As the established voice for defense and veteran credit unions that serve our nation's military members, veterans, and their families, DCUC is committed to ensuring a strong and independent NCUA that effectively regulates the industry and protects the Share Insurance Fund. Our comments today are for the NCUA board to consider before finalizing its budget. An effective budget is made from strategic choices. Even in times of streamlining, the question should be where reductions will be made as opposed to how much of the reductions will be. We appreciate that the NCUA is providing a more streamlined budget for the next 2 years, which will save credit unions that must pay for the agency's operations and the Share Insurance Fund. But there are ways that these budget decreases can be more strategic in our opinion. First, we believe that fewer credit unions automatically warrant a proportional decrease in supervisory expenses, regardless of any directive to streamline expenses. As of July 30th, 2025, the NCUA supervised, we believe, 163 fewer federally insured credit unions compared to the same time last year. This change alone saves time and money and should be reflected in the budget. Second, as examination staff and resources presumably decrease in the next 2 years, we encourage the NCUA to lengthen its periods between supervisory examinations further for additional savings. Periods can be extended for CAMEL's 1 and 2 credit unions, ensuring effective supervision and protection of the Share Insurance Fund while freeing resources for higher risk credit unions and priorities. NCUA's recent investments in technology and process improvements should enable longer examination cycles for qualifying credit unions, and the NCUA should be able to capitalize on its $1.7 million investment in 2025 to update its modern examination and risk identification tool, or merit examination system, as well as its additional request for investment for 2026 currently proposed at $2.9 million. Third, we believe travel expenses can be decreased further. The NCUA stated that the budget is reduced for 2026 due to a 23% reduction in staffing, a 24% reduction on contract services budgets, but only a 13% reduction in budgets for employee travel. Given the agency's 23% staff reduction and an increased reliance on digital examination tools such as Merit, which will receive an additional $2.9 million, DCUC believes more supervisory interactions can be conducted virtually. Similarly, the $1.1 million allocation for state examiner travel to NCUA-sponsored training classes can be reduced by half as virtual training continues to prove effective. DCUC encourages the NCUA to re-examine its budgeted travel and training expenditures, as we believe more savings are achievable in this area. Fourth, DCUC is concerned that one of the largest proposed budget reductions, an 82% cut, is to the Office of External Affairs and Communications. According to the staff proposal, OEAC will go from having 16 staff members in 2025 to only 3 in 2026 and 27. While part of this reduction is likely the result of reorganization functions in different divisions, the decrease is dramatic. Given the agency's ongoing transformation, this could be the wrong time to diminish a function that ensures open communication with industry stakeholders, Congress, and other regulators. OEOC uniquely reports to the chair of the NCUA and not the executive director or the entire board, which ensures that the agency's external communications align with the chair's priorities and objectives. Curtailing its resources could inadvertently reduce the chair's abilities to set the tone of the agency in its outreach strategy. DCUC strongly encourages the NCUA to preserve and prioritize OEAC as it finalizes its budget, further reorganizes, and fills vacancies. Fifth, we're concerned about the 30% reduction in budget and 22% reduction in staff within the Office of Credit Union Resources and Expansion, or CURE. A vital office, we believe, in supporting chartering, field of membership expansion, and assistance for low-income and minority credit unions. As CURE manages the community development revolving loan fund programs and training opportunities, reduction in staffing and funding could slow these processes and limited credit unions' access to necessary resources. We encourage you to look at this area as you finalize the budget. Noting our concerns with the budget and staff reductions, we urge the NCUA to offset investments in these divisions with further budget reductions to the Office of Consumer Financial Protection. We're concerned with the proposed OCFP budget decrease of only 28%, given the significant budget and staff reductions over at CFPB. Other regulatory agencies, particularly the CFPB, are not conducting examinations of larger institutions and non-banks due to part of the significant reduction in examination staff. Regulatory parity means that oversight should align with systemic risks. We encourage the NCUA to reduce the OCP budget to focus on consumer protection resources and higher risk institutions, direct resources to less costly financial education initiatives, and ensure proportional consumer compliance for credit unions under $10 billion. We appreciate this opportunity to collaborate and work with you, Mr. Chairman, and the staff, and we thank you for the opportunity to provide feedback and happy to answer any questions you might have.
Gotcha. A lot of these are, please save lots of money, but don't cut the things that I think are valuable. By the way, on OEAC, External Affairs, just to clarify, and maybe these guys can give more detail, but if you see, oh boy, it had this number and it has a much smaller number, some of the things were just transferred to CIO. So the same, like our website, maintaining that, everything we put, the accessibility, closed captions, our social media posts, those are all still happening by the same people. We just shifted what department it was, right, to the, it was always kind of a tech/comms function. And it's just more in the tech world now, so I wouldn't get too stressed out about the reduction in the number, because just because the person who put our social media accounts out is now working in a different division doesn't mean anything has changed in your life.
No, and we appreciate that clarification. That was an issue raised by some of our credit unions on our
Look at
monthly
the top of the number,
advocacy
wow,
calls.
looks like, no, but anyway, go ahead.
Yeah. And I think, Melissa, you talked about this in your remarks. The staff draft, again, development months ago, it reflected, so when you look at the tables of the individual offices in the back of the staff draft, that reflects the post-VSP results. So whatever we had going into the year minus who we knew was leaving, that's it. It doesn't reflect what the future state's going to be. So in OEAC's case, in addition to the office, as one example, in addition to the movement of some of that function to another office that now still exists, it's just somewhere else. The remaining number reflects, the number of people we'll be going into next year with post-VSP, but it doesn't reflect what any additional allocation may or may not come as part of the future state reorganization plans. There's the 23 positions that were incorporated into the head count for the staff draft that were unallocated. And under the new executive order and OPM guidance, we have to go, we have a process to go through to allocate that. So it doesn't reflect what this final state going into next year is going to be. It's just simply where it was going to be day one, and then we've got to decide what to do with the 23 positions. Okay?
Going back to comms, because that's important, OEAC. Outreach has DCUC found effective from NCUA. I don't, if the folks at DCUC have been around for past changes, right? I know we've changed that office. It used to have a different name, Baca or something. Paca. Oh, yeah. But anyway, all of this is, and this is rare for government, you're not doing all the nice to haves. You have to focus on the must haves. The good thing about this job that I always like is we have a very clear true north. We are an insurer. And like every other insurer on earth, you like taking in premiums and you don't like writing big checks, and you certainly don't like exhausting your fund. Okay, there's a very clear true north. But what have you found effective in terms of if you had to strip out some of these things, right? What have you found effective? What is useful that NCUA does from a comms perspective or less useful? Because remember, we can't do all the things.
You can't do everything. No,
Nor can your organization or anybody else.
No,
right?
you don't have an unlimited budget. I
Right.
think that your ability, when you're pairing releases, when you're pairing directives, when you're pairing instructions, and we're pairing trainings, it's as clear and as detailed in that first meeting. So that I think what you guys have stepped up on and done a much better job of, I've heard from our credit unions, is that, okay, we understand now where they're going. We understand we don't have to have a follow-up meeting to have a follow-up meeting to ask another question. So, because they believe it's a waste of their time, it's a waste of your time. I think that there has been a much more clear emphasis on, here are the facts, this is what it means, do you have a question? And inviting and accepting feedback from the industry.
Gotcha. I appreciate it on that. I know that one of our biggest complaints we get in our feedback survey is duplicative requests, for example, okay? You can handle that a bunch of ways. There's this convoluted stuff in the portal. When I sat down with an examiner and said, why do people ask for a document? Why do we ask for a document again we asked before? And well, they've been added to the exam, the new examiner, like maybe somebody had an emergency, and so, and I sat down and said, how does this happen? They get added to the exam in this system, they get added to the portal to see the docs, and I was amazed it works as often as it does, because it's harder than it should be. Another thing is, do we really need to ask for so many documents? One way you don't have to ask for a document twice is don't ask for it in the first place. So, and I think we got in the habit over the years, and again, this is what happens in a monopoly service provider of, we should ask credit unions for that. We should ask credit unions for that. And it winds up being this thing when it really ought to be more like when you go to a physical, everybody gets the vitals, you get your blood pressure, et cetera, but some people need a CAT scan and some need an MRI, but not everybody. It's an if-then thing. So we're trying to work on that to reduce the communication. All these things are excess emails and time and things wrong, right? And when someone says, can you send that to me? Well, we better need that thing we're asking.
I think you're right, Mr. Chairman. I think if you compare it to
Your
the.
mic's on, right?
Oh, no, it's green. I don't know if it's on.
It's lit up green, that's right,
Okay.
that's cool.
I think that analogy is perfect. Like, when you come into the exam, here are the basics. Okay, now we see something we need to ask more. You shouldn't assume that the patient has cancer, so we need to work back from that
Right.
point.
Why are you running a CAT scan?
Well,
So-
and I think it's also beneficial to smaller credit unions as well, is that when the CEO also opens up the door, maybe he's the teller for the first hour, that, I've got to spend 6 hours this week to provide all these documents. If they don't understand, it's going to take me an hour. Here's the streamline. Here's the, You know, here's the, I can do my taxes on the back of a postcard type of mentality.
Examiners will admit they don't have time to look through every doc. They ask for it because it's on a list they have to ask for. And so, well, wait a second, we're obviously surviving without, so we're trying to shift that burden. Nothing changes unless you change people's incentive structures, right? So why do you want the CAT scan? Why do you want this document? It's perfectly reasonable. It's important. The people who decided to add it to our list aren't crazy. It made sense. But make the examiner have to write, why do you need this particular one, right? And then you now shift the incentive structure, which you can still get the doc. It still makes perfect sense, but you got to put why. All right. Shall we move on? Jennifer?
Thank you, Chairman Hopman. My name is Jennifer Wagner. I'm the EVP Chief Advocacy Officer at the Go West Credit Union Association, which represents credit unions in 6 Western states. Appreciate the opportunity to testify today and want to recognize the importance of this budget hearing process, which provides a platform for public testimony that is unique among financial regulators. This transparency allows stakeholders to share insights and concerns directly with the agency, fostering a more collaborative approach. Go West and our member credit unions stand behind the NCUA's purpose in executing its primary mission to ensuring the safety and soundness of the credit union system. A strong, stable regulatory structure is essential for credit unions to deliver a not-for-profit cooperative financial services option to consumers and communities across the country. Throughout 2025, the NCUA focused on driving efficiencies, improving service delivery, and aligning resources to statutory and administration priorities. That work by agency staff over the last year will allow the NCUA to fulfill its primary mission in the proposed 26-27 budget, resulting in the 23.5% decrease in the 26 operating budget, on top of a 41.6% year-over-year reduction in the share insurance fund budget. The $81.5 million total budget reduction in 26 is savings that directly benefit credit union members. In addition, it is apparent that the agency's longtime commitment to internal succession planning and building bench strength set them up for success with the voluntary separation program, ensuring stability for the organization and its regulated entities. Go West has been a strong advocate that the budget for the regional exam teams is key to NCUA delivering on their mission and should be the largest portion of the budget. We were pleased to see that the 26 budget prioritizes examination and supervision over the administrative budget, and that much of the savings realized were on the administrative side. As importantly, the changes that have been made in the NCUA's exam program to drive efficiencies are already being felt by credit unions in the Go West region. Credit union leaders have shared recent examples of improvements to their exam experience, including fewer examiners on site, all remote exams, shorter exam times, and improved pre-exam preparations. I'd be remiss in not recognizing the leadership of Julie Case, Western Region Director, during this transitionary time. As we review the proposed budget, we respectfully encourage the board to ensure that resources remain aligned with risk by prioritizing staffing within the Office of National Examination and Supervision. ONES plays a critical role in supervising both corporate credit unions and the unique needs of the largest natural person credit unions, which together hold a significant share of insured assets. While a failure within this group is highly unlikely, the impact to the share insurance fund would be outsized, and under credit unions' shared risk model could create losses for all federally insured credit unions. Maintaining a well-staffed and highly skilled ONES team is therefore essential to safeguard the system. At the same time, we encourage the NCUA to prioritize staffing of CURE. CURE remains a vital resource for small and emerging credit unions by supporting chartering, compliance, and development needs. Capacity in this office is crucial to ensuring that credit unions of all sizes can continue to thrive. We were pleased with the overall direction of the budget. We do have a couple of areas of interest. The examiner training budget will see a 33% cut. Training is key to not only continuing to execute efficiently, but critical as credit unions and the financial services marketplace is evolving at an incredible pace. In addition, we seek understanding on the purpose and role of the 22 new FTE designated to cross-cutting agency expenses housed under the Office of the CFO. Finally, we strongly encourage the NCUA to maintain its investment in relevant staff travel, which promotes communication and transparency with the industry. In closing, I extend my sincere thank you to the board and staff for granting me this opportunity to testify.
Thank you. You mentioned ones and cure and urge staffing. How do those offices you mentioned, back to the regional discussion, right? Are there regional issues, like speaking to having people closer to it? Just as a general matter, when we do all of these budget cuts, the closer it is to the credit union exam,
Agreed.
and the closer it is to our core mission, which is, do we write a check or not to bail out depositors, right? The closer it is to that, the less we want it to be affected, right? It should be a top-heavy HQ stuff, like a lot of organizations. But you're Arizona, Colorado, you're 6 states, right? Arizona, Colorado, Idaho, Oregon, Washington, Wyoming. Can you talk anything about why region mattered, being close to it mattered?
Yeah, and I agree with the.
And why a potential budget cut, let's say, and staffing cut could harm that? Go ahead.
We have developed a very close relationship, as have credit unions in the region, with the Western region staff. I think, as was discussed earlier, that staff understanding the unique economies of the regions, having the expertise based on the historical field of membership and unique consumers that are being served makes sense. In reference to the ones group, that unique area of need could be delivered at the region level or at the administration level, but understanding just the unique needs of those credit unions. Same with the small credit unions. Greatly appreciate expertise specific to some of those unique needs.
All right. You mentioned staff travel, communication, transparency. How's that manifested itself?
A couple weeks ago, the Go West hosted our MAX conference and have historically had NCUA, both from the board and the Western region, attend. We host regulatory panels where the NCUA staff join their state regulatory counterparts. And it is probably the most popular session at the entire conference. Creates relationships, builds trust, and allows for continued communication regarding what's coming in the next exam cycle.
Which conference was this?
The MAX conference.
Is that ours?
That's our Go West annual.
That's your Go West one,
Yep,
okay.
yep.
And who was there?
Julie Case
Okay.
from the Western region.
Gotcha, all right. Thank you. Turn it over to Michael with NCUA.
Thank you very much. Good afternoon, Chairman Haltman. I am Michael Edwards, counsel for the Cooperative Credit Union Association. The association is the state trade association representing approximately 200 state and federally chartered credit unions in the states of Delaware, Massachusetts, New Hampshire, and Rhode Island, which further serve over 3.6 million consumer members. Thank you for the opportunity to express our views on the National Credit Union Administration Board's proposed 2026-2027 budget. First of all, the association commends the board for proposing budgets that would be 20.6% lower in 2026 compared to 2025, as well as 12.8% lower in 2027 versus NCUA's 2025 combined budgets. These savings should be used to increase the National Credit Union Share Insurance Fund's reserves. Doing so would reduce the likelihood of a double whammy of share insurance fund premiums levied on federally insured credit unions at a time when those institutions would also likely face increased loan loss expenses due to the current expected credit losses, or CECL accounting standard. If the fund later becomes overcapitalized, the board should at that time issue a dividend to increase federally insured credit unions' institutional net worths. As you know, the NCUA is funded by federally insured credit unions through two mechanisms: the overhead transfer rate, under which a portion of the share insurance fund's interest income is transferred to the NCUA's operating fund, and two, the operating fee levied on federal credit unions. Reduced NCUA operating costs proposed in the 2026-2027 budget should be used to reduce the overhead transfer rate so that these savings flow to the reserves of the share insurance fund and help protect federally insured credit unions from future potential share insurance fund premiums in an economic downturn. Based on the NCUA's most recent share insurance fund report issued in September, as of June 30th, the share insurance fund's equity ratio was 1.28%, which was 8 basis points above the statutory minimum of 1.20%, but 5 basis points lower than the fund's normal operating level set by the board at 1.33%. The fund's current equity ratio is largely the result of increases in insured shares over the past few years, but also because a significant portion of its interest income has been used to fund NCUA operations. The Federal Credit Union Act requires the board to levy a share insurance fund premium when the equities ratio falls below 1.20%. This can result in so-called pro-cyclicality, which bank supervisors define as a causal feedback loop by which the financial system amplifies the business cycle, possibly leading to increased financial instability. In other words, when financial conditions deteriorate like they did during the global financial crisis 15-plus years ago, federally insured credit unions can get hit with multiple high costs at once, including not only share insurance fund premiums, but also increased loan loss expense. CECL increases the potential for this type of pro-cyclical feedback loop because CECL focuses on expected credit losses instead of incurred losses, and it also factors in macroeconomic conditions. This means that a negative macroeconomic forecast could result in increased loan loss expenses for a federally insured and credit union, even if that institution does not experience increased loan delinquency, let alone defaults. In a financial crisis, when it rains, it pours, and CECL will make it pour harder. The board should reduce the chances of a pro-cyclical share insurance fund premium by using budgetary savings to increase the fund's reserves. When the fund's reserves eventually exceed its normal operating level, the board should then authorize a dividend. This would protect the fund by increasing all federally insured credit unions' institutional net worths, and those net worths stand in front of the fund's potential liabilities. Second, the association urges the board to ensure that NCUA retains staff who are knowledgeable about credit unions so that examinations and policymaking focus on material safety and soundness, Bank Secrecy Act, or consumer protection risks. We recognize that many long-tenured NCUA staff have recently departed, depleting the agency of human capital. As member-owned financial cooperatives that exist not for profit, not for charity, but for service, credit unions need examiners who understand how credit unions typically operate. Ideally, small credit unions, examiners, and the Office of Credit Union Resources and Expansion should be able to provide technical assistance to improve small credit unions' operations and strengthen those institutions. Larger, more complex credit unions should be assigned examiners who understand those institutions' operations and the risks associated with it, but also allow the managers sufficient leeway to run their credit unions as they see fit, so long as they're compliant with applicable rules. Lastly, we urge the board to focus its examinations resources based on the potential risk that a federally insured credit union presents to the share insurance fund. Small credit unions generally do not present material risks to the fund, and larger credit unions do not necessarily present material risks unless they're engaged in complex, excessively risky operations or investments. As of June 30th, there were 2,589 federally insured small credit unions below $100 million in assets, which collectively had total assets of $77 billion. That was significantly less than the total assets of Navy Federal Credit Union alone, which had approximately $192 billion in total assets on that date. Even combined, small credit unions represent less than 4% of the approximately $2.4 trillion in total assets of federally insured credit unions. While size is not always a measure of complexity, the small size of these credit unions, even as a group, mean they do not present a material risk to the fund. With larger credit unions, examinations should focus on the most complex and riskiest institutions because they present the biggest risk to the share insurance fund and, by extension, to the federally insured credit unions that can be liable for premiums. Thank you for the opportunity to share the Cooperative Credit Union Association's views concerning the proposed budget. I'd be happy to answer any questions the board may have. Thank you again.
Thank you, Michael. You're certainly right about the pro-cyclicality. That is something in nature of the beast. It's also why people don't want to lower our normal operating level too low, because then we're closer to that, right?
Yes.
You want some room before we have to ask you to check. 2 years ago, during some gyrations, the Silicon Valley Bank went down. You know, I'm not here to criticize those regulators at the FDIC in the slightest or say we would have done any better, but markets are gyrating, and what happened? Lots of banks were asked for 7, 8, and 9-figure checks to top up their fund because they lost like something like 11, 12% of it. That was not fun. Now, it did wind up being a systemic issue, but it's, hey, everyone's losing money. You know what we need? We need you to just pay us more, right? It's a tough time to do it. That's the nature of it. You mentioned CECL. That was not us. That was FASB. I've never liked that. I've been very clear about that. It is not really designed for nonprofits. It's not really that relevant to the budget hearing, but I understand why you brought it up. I want to ask these guys, whoever's their CECL, the most expert on CECL, that want to explain that we've done as much as we can on that. That was FASB, the accounting board, right? FASB is a child of the SEC when the SEC outsourced the accounting part of the SEC's job, right? When publicly reporting companies, the accounting is important. The SEC basically hands that to FASB. The reason I mention that is CECL is very much a product of that. Even go to their website when they talk, FASB, you talk about CECL, it mentions investors. There are no investors in nonprofits. So I always thought it was kind of a square peg in a round hole, you know. So I believe, and I remember going through this, we did, I think, as much as we could to spare credit unions from it. Can anybody speak to what we absolutely had to do versus CECL? Like just that we were required to do versus CECL versus how it could have been?
So I maybe cannot speak to that specific question, but I know that the NCUA did try to exclude credit unions from being required to comply with CECL requirements. We do have in our, regulations, the ability to exclude credit unions 10 million in assets and under, because they're not 10 million, in assets and under. So credit unions that are under 10 million do not have to comply with CECL, but any credit union over that asset size does.
And if I could just clarify my remarks there, we're not criticizing CECL. CECL is the way it is the product of its disclosure regulatory regime rather than the safety and soundness. Yes.
Yeah.
But it's cited in our written testimony here, the Basel Committee on Banking Supervision has done a working paper meaning the pro-cyclicality standard. And so that's just in terms of where the funding goes. If it ends up being a dividend that would go to all federally insured credit unions, they would see actual savings. But, getting there, avoiding, premiums is something that is also going to, help their capital levels. So anyway, it's just going to be more pro-cyclical than before, and that's just something we suggest taking into account.
In terms of just reducing the denominator of total work, which we have to do since our numerator of number of people is down 27%. How much latitude do we have on that 10 million as a reg? Because that wasn't Congress and it wasn't FASB, right? The 10 million number is hard-coded?
The 10 million's in the statute.
I thought Kelly said reg, so I thought maybe that
Well,
was.
so
Statute.
in the reg, we could have chosen to impose CECL on less than 10 million, but we didn't.
But we can't say 100 million, right? Congress just doesn't allow
No,
it straight up.
because Congress says any crane that's 10 million, the Act says any crane that's 10 million or greater in assets has to follow GAAP.
Right, so there's nothing we can do about it, and that's GAAP now, according to FASB, because they determine what GAAP is, I guess, yeah.
We did a host of things within what we could control.
Yeah.
The 10 million and less, of course, we said, no, you don't have to follow that. And
There's one thing you don't have to deal with an examiner, and a credit union doesn't have to do, is talking about your adhering with CECL if you don't have to adhere to CECL.
Yeah.
But I remember we were a little bit in the bind.
yeah, we came up with the CECL toolkit or it's a workbook. It's helped smaller the bigger than 10 million, but still small credit unions do it in a simplified way. And we worked with FASB and the AICPA in developing that, as I recall.
And that's been a great resource, and we completely support that. Our point is really that,
Yeah, I know.
we're going to have
Yeah.
loan loss expense at the same time they're
That's
doing
right.
insurance premium.
One of the other things we obviously did the phase in, that was the day one charge. Doesn't necessarily help in the future. But one of the things we did do, we can't control how the net worth ratio is calculated. That's hard coded in the statute, right? And it's gonna, if your CECL balance goes up, it lowers your net worth. But I believe in risk-based capital, we do, at least the part we can control, risk-based capital, you get to count the allowance account balance. So CECL makes the allowance account go up. You're still counting that in the numerator. It's a form of loss absorbing, right? I think that's right. But anyways, I get your point. Like, there's still the pro-cyclicality of it, to the chairman's point, that came from FASB.
Yeah.
We did what we could, right, within that realm.
Right, and you're also just more limited than FDIC is to, draw out these assessments if they do happen. And so that's another thing, that it can come really fast.
FDIC has latitude when they have a hole. I did not envy them trying to pick which banks they had to hit to cover 25 billion. For better or worse, NCUA just has to levy it against everybody if we have a hole. Hey, Melissa, Michael mentioned the SIF, right? 1.28 was our latest number. 1.33 is where we give money back. we talk about the budget and the savings in terms of dollars and percent. Is there any way we, in terms of the SIF, right? I know there's some mechanics, transfer rate, but at the end of the day, there's only one bucket of money, right? Credit unions put some money into a bucket. We take a slice to fund us at NCUA. Federal people obviously pay more, federal credit unions, but there's only one real bucket, right? At the end of the day, that's the only bucket of money. How much is all of this versus, remember that red line that was higher, that was the old projection? How much of this in terms of the SIF? Is there a way to express it that way? Like we're saying, your bills will be lower if you're federal. We're saving millions of dollars. We're spending less. There's percentages of that. But is all of this worth, say, a basis point in the SIF indirectly? Like, let's say we've gone on into the staff budgets. Can you bring, was that slide 8? Want to bring that back up?
That's slide 7.
7, the one with the red line and one up in the bottom right? Okay. Let's say we stayed on that universe. There we go. Top red, right? Versus, let's say we go with the staff budget there on the bottom right line. How does this trickle down to the SIF? At the end of the day, like
I
if
mean,
you
I
had to
could
measure it.
answer, like, from a process standpoint, I don't know if I have the
And
actual
is all of
basis
this worth a
points.
basis point at the end of the day?
I read 'em.
Right, 'cause remember, if we give it directly back to credit unions, then it doesn't stay in this bucket, right? So that's cash back to the credit unions, but,
Yeah, I mean, I think I'll
Yeah, is
just,
there a way
I
to
can
express this in terms
comment,
of the
like,
SIF?
Michael's exactly right, like, in your testimony, I mean, we talked really initially, the operating fee piece is kind of obvious, but then, as the operating fee decreases, the de facto amount the credit unions pay through transfers for insurance fund also are decreasing, so we anticipate that all that will be less next year due to the lower budget. Positive for 2 reasons, right? One is that more funds will remain in the SIF, at the end of the day. Second, all things being equal over time, this is a potential to result in a higher equity ratio in the SIF. And that means the funds are generating a higher net yield on investments and then potentially falling below the statutory equity ratio requirement of 1.2, shortening the time frame to reach or exceed the normal operating level. Which the dividend, NCUA pays dividends to the SIF members. So I think all of those things moving in the right direction for,
I mean, if we did, Melissa, Jim, you jump in here and I'm going to do like back of the envelope math here off the top of my head, but let's say it's 100 million less, I'm rounding, right, just for simple math. So it's going to be 100 million less than what it might have been. Roughly 40% of that's paid for out of the operating fee. I'm rounding, right?
That's right, about 60 million would stay in the SIF.
All right, so 40 million lower operating fee, that's a direct expense, right? A bill that's sent lower, 40 million. And 60 million that is not then withdrawn from the insurance fund through the overhead transfer. I'm again making rounding here going on, and that's the high level math. And in the old days, I don't know what it is anymore, but roughly 110 million was 1 basis point on the SIF. I don't know if it's probably more now, but.
Yeah, it's 60 million divided by 23 billion, so I mean, I left my phone downstairs
about
because
that.
I didn't want it to beep
I
in
got
the
you. But if
hearing, so
we-
I can't do
But
the
that's how to think about it.
calculation.
I mean,
That's how
not
to think
passed
about
any
it.
of the savings on, right? For example, I think if we don't pass the budget in time, the way the law works is we just have to continue at last year's, right? So we still spend less, we would just sit in a cash account here, right? And that, it's kind of a trade-off between how much lower the bills are, direct cash to federal credit unions, or can it just find its way to eventually sit in the SIF, which helps you indirectly, but nothing's as good as cash today. Let's switch to, we're now at the point where it's a conversation between the people on this side of the table and the people on that side of the table. Kurt, you can ask my colleagues questions. Go ahead.
Sure, thank you, Chairman Hopman. Question, and not sure where to direct it, but as the agency is evaluating the one's division, just would be curious to know how you think through the right size in terms of, overall size and cost devoted to ones, and how that relates to how you see the risks, systemic risks, for the credit union industry.
So could you ask that again? I'm sorry.
Sure. How does the agency evaluate whether one's current size and cost are proportionate to the risks presented by the credit unions that it supervises?
So the current size and cost of ones relative to the risk it's handling. Well, so they've we have a supervision and exam model for the largest cranes. We also have enhanced regulatory standards, capital planning, stress testing, among others, for the largest cranes. And so there's the math that goes into what does it take to examine that portfolio of credit unions, right? And there's obviously choices we've made about how to examine them, supervise them, the time it takes, the level of expertise needed. There's not a direct algorithmic approach, though, like that exactly equates to this risk. But between the regulatory standards, the enhanced regulatory standards, the enhanced examination and supervisory standards, which include enhanced data and analytics for those institutions, I mean, we do believe that historically that has been a good approach to managing the risk that those institutions pose to the SIF.
And then as the agency pursues its reorganization, will there be an opportunity for stakeholder input?
So I don't think we were planning to put out the exact reorg out for comment, but obviously as we go through that process, board decides, there'll be opportunities along the way for people to, provide input and say, hey, you might want to, fine tune this or that. But I think big picture, that's a board decision.
I will say this, we have every incentive to get this wrapped up, right? The White House has sort of ended the hiring freeze, but they've added a whole bunch of caveats to hiring, so it's not like we're back where we were. We got this whole team that's done great work, selected from different parts of the agency. We call it NCUA Cares. They've been meeting. It's a lot of, so, nobody needs more meetings than necessary. So we have a lot of incentives to get this new NCUA done, communicated internally, et cetera. You can't have 23% of people leave and look and try to do things the same, right? We don't try to do more with less. We try to change what we're doing. So if we had, over time, 23 different departments that answered to no one except the board, that number will change, the structure. We might not even use the same nomenclature, but people who work at NCUA, above all things, are waiting to find that out. What department am I going to work in? Who am I going to report to? So we have, put it this way, we have a lot of incentives to get this figured out soon, and it obviously impacts the budget. So I think we'll have the broad strokes probably by December, broad strokes, I think, when we approve a budget, okay? It's going to look different. Let's see, you work at an entity that is a recent merger of two totally different things with different IT systems and different names for departments and divisions and everything. And so you had to do kind of a reorg of a fashion, right? And it's not easy. It takes a while, but you have the same incentives of us. People want to know what this thing is that they're working at. So I know you guys have been through that. But.
That's all exactly right. I would just add to it that the draft budget does reflect the head count we would envision under whatever structure we come up with. So, and then the dollar budget that goes with that. So it's not like, oh, we're going to then make additional reorg decisions that are going to materially change the head count or dollar budget. It's within the context of those numbers.
Well, I'll just say, again, thank you very much for all the work from the staff's part, and appreciate being part of this dialogue, and no further questions from me.
Jason Steverag from Defense Credit Union Council.
Yep, just got one question. The draft budget includes $10 million for the NCUA's implementation of its reorg plan and investment in systems and processes improvements that align with government efficiency goals and other administration goals. Can you provide any details on how this $10 million will be used for this goal?
So, again, when we were developing the staff draft, we knew we were going to have a big reorg. We also knew we had, various administration priorities to make sure we invested in. One of which is to enhance the customer experience, right? Customer service, maintain and enhance. When you do a reorg, there are costs, right? And so, we didn't know exactly what those were going to be. How much is going to be reorg costs, how much is going to be investing in some additional AI or other process technology improvements. So admittedly, right now, the $10 million that's what we've set aside. And we'll be in the process over the coming months of figuring out exactly what what we'll use that for. We're already in the process we've piloted Microsoft Copilot as an AI. I think we're going to be rolling that out pretty broadly here soon. We're looking at some other capabilities. We've got some various technology projects in place that will need to continue to improve the customer experience, like chartering, FOM, other requests from NCUA for decisions or actions or approvals, to try to better automate that, to also allow the applicant or the requester to kind of see where things are in the, you can tell, like, how when you order something nowadays on certain apps, you can see where it's at in the process. So we're doing a lot of that because the efficiency side of that is not, it's obviously a better experience, I think, for the user, right? It hopefully cuts down on the confusion and the misunderstanding or the calls for like where things at, which takes your time and ours. So that's an efficiency gain in and of itself, right? And so we're looking at a lot of that, but no, we don't currently have an exact roadmap for the 10 million at this point.
Okay, I mean, and I guess final question is that, is it we're gonna spend 10 million, or it's we have spend up to 10 million, or hey, we can do this for 5 million? I'm just getting kind of that government mentality
And
question.
so again, assuming that this gets approved in the budget, because this is a staff draft at this point, but let's say the final budget includes the 10 million, it's up to 10 million.
Okay.
It doesn't mean we'll spend the whole 10 million. And historically, if you look back at our budgets, we don't overspend the budgets, right? So we wouldn't spend the more than 10 million per se. It would be within that. But if we went through all of this and the reorg costs were a couple million and we bought this AI or that AI or this technology and it ended up being 8 million, then it was 8 million.
No,
What you were telling me, Larry, earlier, that one of the reasons we tend to come in a little under whatever we approve is like, we're allowed to spend less, but we can't spend more.
Yeah. So the way it works is, and I don't want to go into all the details as to why in this setting, but essentially when we've locked in the total budget, we can't spend more than the total budget. Now, we can reallocate throughout the year within the total budget, right? If there's some savings over here, but we need to use it over there, but we're not going to exceed the total budget, right? And so because of that, you essentially come in a little less. If you're managing it very close to the line, you're still going to come in a little bit less than the total, although individual line items may vary, right?
and just one final thing, I'd be remiss, because a bunch of our CEOs asked to pass along our thank you to the staff. We know that there's been a lot of, not upheaval would be the polite word, but just challenges that you've experienced. And for the most part, our people have not experienced any downtick in terms of service or quality or answers or temperament or anything. And that's testament to leadership of the hundreds of of you guys and the hundreds of people that you lead. And I was asked to pass that along to you.
One thing I've learned in management is that we always focus on problems and trying to solve them, right? That's a big part of it. What you're doing right matters a lot. And trying to do some more of that and giving credit there, because I think the nature of a lot of these things is you tend to focus on where the leak is. But what you're doing right matters an awful lot. Jennifer Wagner, from, you are the Go West Credit Union Association.
That's right, thank you. One of the items that we brought up in our remarks was around the 23 FTE kind of placeholder. And I think as the discussion has ensued in the presentation, just want to confirm that's a kind of holding place for after the reorg is complete to determine where there's a need and
23 where? FTE where?
23 FTE kind of placeholder.
It's on page 26.
Yeah, it shows up in the budget as something called agency-wide or undistributed cross-cutting expenses.
It's not in
Yeah.
a department, it's just kind of.
Right.
And they
Okay.
don't really, the positions, they just haven't been allocated yet.
Okay.
I think as Larry may have said, or Melissa said in her presentation, we're just holding them there in anticipation of the fact that, we will hire up to the level that we're allowed to hire to. We can't go above 970 or 967 if you exclude the central liquidity facility. But those positions don't have a home yet because the reorg is still in process.
Got it. Thank you.
And then the hiring phase was in place up until just recently. So, and I know the chairman referenced that there's a whole series of procedures that we have under the new EO that will help prioritize hiring and make sure it's aligned with the administration priorities and the highest need of the agency. So that's where we're standing up now.
Which is why we didn't try to detail them in
Yeah,
here. It was
that makes
just
sense.
like, we've got the money for them in here, because if you didn't have the money for them, you couldn't do it, right?
Right.
But we don't know exactly where they're gonna land yet, because we're still going through that whole process of figuring that out.
And that makes complete sense. Thank you.
And out of 200, and I can't remember the numbers these days, about 250 people put their hand up, something along those lines.
Right.
As we sit here on November 5th, there's 70 or so of those people that are still to go because they worked through the end, their deal was through December 31 or thereabouts. So even of the, that has no impact on the money because everybody took a deal was paid through December 31. But we still have some adjustments to go, a solid chunk. Let's call it 70 out of 250. I think I'm about right. And there's a lot of important people. Where we're going to have, the priority for filling holes is so that what Jason said about they have a notice on the ground, that's the priority. If there's going to be any pain, I want it to be in this building, not out there. You know, so ballpark, we don't quite know exactly how this new hiring world's going to work, no matter what we're committed to coming in at 20% reduction, right? We're at 23, so you got a little latitude there. Plus people just leave because that's just life. The priority is closest to exams, right? But then we, again, not trying to do everything exactly the same way we did it last year, right? Because that's just not going to work, right? We want to make sure closest to exams, but make sure every single minute and every single email, we've done it so it's as mission critical as possible.
Thank you. Appreciate that commitment. Final question. The budget obviously relies on the extended exam cycles, which credit unions are very supportive of, and offsite analytics. Just curious if there are discussions around additional tools or training that will help examiners in that kind of new extended process.
I'll take that question. So, yeah, the extended exam cycle has definitely helped our staff and credit unions as well, I think, reduce burden on them in terms of the examination. For training, there's a lot of things going on at the agency. You know, you've seen our recent proposal on removing reputation risk from the examination. There's information that's gone out about changing the way that we do the examination report, we're not referring to risk ratings as part of the examination. So as we continue to update examination supervision policies, we're definitely keeping an eye on staff and making sure that that gets communicated in training for them as well. In terms of analytics, I know we're working on some new offsite analytics for our team. We'll be rolling that out in 2026 as well as part of merit and part of offsite analytics. So there will be training associated with that too.
Great. Feels like a positive development. So thank you.
Absolutely.
That's it. That's all I have.
A huge fan, and banks do it too, and Congress mandated it for some things, the earning a longer exam cycle.
Well said.
Right? If you're the same as any insurer, whether you're State Farm or you do property casualty or whatever, some risks are more than others, and you care about where your risks are. So if there's a credit union with tons of capital, one of those ones where we kind of wish they took a little more risk because, but they're indisputably a Camel One. They have piles of capital. They can withstand all kinds of problems, and they're a 4-hour drive through the mountains to get to, and they have, $3 million in deposits. We don't need to see them solely because the calendar year has passed. We don't need to go see them just because the earth has gone around the sun once. We have other priorities. So tying it to earning, people say, I want to see my examiner less. Well, I get it. But as much as possible, I want us to push the envelope on earning it because that is totally in line with what an insurer would do, right? The ones that just missed that cutoff for the longer one, they now want to do what they have to do together, get their act together, get their capital up, right? So that's good for us as an insurer. The ones that are super low risk, lots of capital, and are low risk just by numerically. And it makes sense for us not to see them as much. And then, so what are we doing? We're focused on the credit unions that do have issues and have just a large financial risk, just numerically, right? Anyway,
And-
so,
and
or
I
we
would
can
just-
push the envelope on that, that's just good policy.
Yeah, and so in addition to the time between exams being extended, which we've done, and I think that's a great approach where you've got to earn it. But we're also looking to wherever possible to streamline when we do show up, what we do and the burden on the credit. So it's really a benefit in both directions, right? It's, yes, you're going to get examined less frequently on average, especially if you earn it. But hopefully that exam will be more succinct, right? It's as succinct as we can make it, right? And including using enhanced analytics, to your point.
And that's been noticed per my comments. The credit unions are already seeing those.
And if there's any examples from other regulators, international, state regulators that aren't financial regulators, always happy to, take ideas from somebody else. In the case of the absolute smallest, the lowest risk, the highest capital one that you'd see the least, right? Whatever the longest exam play we could possibly justify, then maybe it's not just the metric of how long between exams. You got this capital E exam. Is there a way to have it really long? Can we do a halftime checkup somehow? Like, especially when we're starting out this thing, for sake of argument, let's say it was 3 years for the microscopic, super high capital, little one. Maybe before we go to that, is there a way to do a halftime checkup or something like that? So we don't need to stick to the same paradigm we've always had. And if anybody has ideas for the way this state does it or the way this regulator does it, happy to hear them. It's always easier for bureaucracies to move when they know another government agency has already done it. It's just the way it is. All right, Michael Edwards, Cooperative Credit Union Association.
Thank you, Mr. Chairman. So I have a question about exam process, and the feedback we've gotten is that the exams, our members have been pleased with recent exams, and all of our members are in the eastern region. But over the past few years, our members have reported that the time to finalize the exams has tended to get a little bit longer because of a quality control process. And our question is whether that quality control process is going to take longer with fewer staff, or whether there's other fixes like machine learning, because we like quality control. Quality control has been good. But is that something that could be augmented with machine learning so that exams are over faster, something like that?
So we've, a couple of things. Part of what doing less with less is we did look at the quality control process, because that also involves work, right, for people, the analysts in the office or the supervisor examiner, right, looking at the report before it goes to the crane to make sure we get it right, that we're following policy, that kind of stuff, quality control. So we are adjusting those parameters to provide more flexibility to keep, so that we continue to do the good quality control, but do it on the same timetables with fewer people, right? The second piece is, yes, one of the AI things we're interested in is can we run those reports through like an edit type thing? You may not know substance, but it can find other thing like, is this clear? Is it well organized? Is it grammatically correct? That kind of stuff. And we've been looking into some different things out there, and we're looking into those type of things too.
And that sounds good to us. My other question is related to the Office of Credit Union Resources and Expansion. There's been a decrease in both the staff headcount and the budget for that office. Do we know how that will impact things like the chartering and field of membership expansion processing times? As well as, the ability of the office to help small credit unions with technical assistance, which, we think, technical assistance is a very good small credit union supervisory approach, as opposed to more of an enforcement approach. Most small credit unions really want to do the right thing. They just might need a little help sometimes, so.
So again, our goal is, as the chairman noted, as Jason, you commented, our goal is to really not impact the customer experience. In fact, we want to try to improve it where we can, even with some downsizing and more efficiency. So, our commitment is to make sure that doesn't happen. Obviously we're human. We may have a few hiccups along the way in the transition, but our goal is for that not to avoid it being affected, and in fact, maybe even, and hopefully even improve it in the process. So, while there's fewer headcount overall, we are finding things that don't affect that experience, the non-essentials that we're shedding, right? We're finding ways to work smarter, right? To do the same, get the same outcome, but with less steps. We're finding ways to use technology, right? All of those sort of things. Again, we won't always 100% get it right, but that's our commitment, is to make sure that that's not the case, that those type of services get affected.
Well, great. Well, that's what we're happy to hear that. So thank you very much. That concludes my questions.
I hear you on the time after the exam concludes before you get your actual results. You know, people are like, listen, we're getting awfully close into the next exam. So anything we were supposed to fix is getting a little difficult, right? When you're, 6 months in to the next exam. I hear you on that. But want to thank everybody for those questions, everybody participating in the hearing. Larry, Tawanda, Kelly, Melissa, Jim. Thank you, everybody who's participated in the hearing. Special shout out to our acting CFO, Melissa, for her work on the budget itself, not just this budget hearing. Want to thank our stakeholders for willing to just have candor and lay it down for us. Communication is useful. And I want to thank staff for their engagement on the general topic, not just the budget, but how we operate with fewer bodies effectively, right? By keeping our eye on the prize. This is a rare position to choose our priorities in a new direction, and this team is rising to the occasion. As we move towards finalizing the budget in a couple of weeks, we're going to review all the feedback in today's meetings, as well as that was submitted through regulations.gov. Remember, we've got time to submit on regulations.gov till November 7th. That is Friday. Okay? And with that, that concludes our budget hearing. Thank you all for attending. There being no further business, we are adjourned.